me start with something that's gonna rub a few people the wrong way. Buying a house too early can keep you broke longer than you think. Yep, I said it. Everybody told me that home ownership was the key to wealth. But when I had finally the cash saved up for a down payment, I didn't buy a house. I actually leased to rent, rented on purpose. And that single decision helped me go from a broke United States Marine Corps veteran and single dad to a millionaire entrepreneur. So in this episode, I'm pulling back the curtain on the biggest lies you've been sold about rushing to home ownership, why renting strategically can actually accelerate your path to wealth. I'm also gonna talk about how I turned rent money into a 7-figure business and the massive shift happening right now with Wall Street giants like BlackRock buying up neighborhoods and quietly locking out the next generation of homeowners. This one's gonna be a doozy, everybody. It's gonna make some people uncomfortable, but it might just save you from 30 years of financial stress. So let's get into the home ownership lie that keeps you poor. Starting in 3, 2, 1, let's go.
Who are we? Hey, 7-figure squad. What we go? Run it up, run it up.
What's cracking, everybody? Money Smart Guy, Matt Sapala here, hailing to you from Dallas, Texas. And I'm excited to share this with you because what I'm about to say might change everything you've been taught about money and the American dream. For most of my life, I was told the same thing you probably heard. Buy a house as soon as you can. Stop throwing money away on rent. Your parents told you that, right? And your friends flex on Instagram with we did a thing when they got the key photos to the house. You see, society trains us like robots. Get a good job, get married, buy a house. Now listen, home ownership can be beautiful. I'm experiencing it right now. But here's a lie. Owning a home doesn't automatically make you wealthy. In fact, for most people, it keeps them financially stuck because it traps the very thing they need most to grow, cash flow. Now, I saw that trap coming. So instead of buying into the script, I wrote my own. I stayed a renter for a long period of time, but a strategic renter. While my friends were mowing lawns and paying property taxes, I was building a national life insurance agency from my laptop in my 2-bedroom apartment. Fast forward a few years later, and that decision not only made me a cash flow millionaire, it gave me the freedom to buy the home I wanted, not the one the bank said that I could afford. And today, my wife and I, we live in a $3 million mansion just because I didn't rush into home ownership. So let's break down the 3 biggest lies that sold America the myth of home ownership. Lie number 1, your home will be your greatest investment. Well, one thing's for sure, it will definitely be one of the greatest amounts of debt you'll ever get. And here's something most people never talk about. Do you know what the word mortgage actually means? It comes from the old French word mortir, meaning till death. So when you sign that mortgage, you're literally signing a debt pledge. I promise to pay until death do you part. Kind of changes the way dream home sounds, doesn't it? When you buy a house, you've got to present the most perfect version of your financial self, the best financial picture. And here's what the banks wants to see. They want to see a high credit score, about 720 or better, a low debt to income ratio below 36%, a steady job history, verifiable, and a hefty down payment, usually between 3.5% to 20%. You're basically saying, hey bank, I'm financially perfect. Please chain me to a 30-year payment plan. But the moment you close, your financial flexibility dies. That house isn't just an asset. It's officially a liability that demands to be fed each and every single month. So let's call it what it is. It's a 30-year debt contract that'll likely cost you 2 to 3 times more than what you originally borrowed. For example, you have a $500,000 mortgage at 7% interest. Well, roughly $1.2 million over 30 years later with $700,000 of that of just interest. See, that's not investing. That's indenturing for sure. Real estate can appreciate about 3 to 4% per year historically. But that's before taxes, upkeep, inflation. For example, just today, found out my AC wasn't working. The thermostat isn't connected to the actual air conditioner. I'm not an AC guy. I don't get paid to be an HVAC guy. I get paid to be a CEO of my national life insurance agency. So what do? I hire a contractor. He's here today. He's fixing the AC. So those are the things that we're talking about in terms of upkeep. You can be a handyman all you like to save money, but are you really paid to do that? Meanwhile, the S&P 500 averages 10% per year if you go back down to 1923. However, a well-built business can compound 20 to 100%. And guess the cool part about that? You control it. So while your investment creeps up 3% a year, this house, your debt is running laps around you. But here's the kicker. The bank's the one investing in you, not in the property. They get paid whether your property goes up or down. So your home is not a wealth engine. It's a forced savings account with high maintenance fees and zero liquidity. And speaking of real estate wealth engines, we've even talked about how a properly structured index universal life policy, otherwise known as a LIRP, a life insurance retirement plan, can be a tremendous alternative to traditional savings and investments. It's a supplement to a traditional retirement plan. I've done it myself, and we've done it for our clients for the last 25 years plus. And just this year alone, we've helped over 10,000 families secure life insurance strategies, either term insurance, annuities, or permanent life insurance. And we still have 3 months left to go. See, that's not theory, that's living proof. There are smarter, safer, and more liquid ways to grow wealth than lock it behind a drywall. Line number 2, you're building equity. Well, sounds so inspiring, right? You're not throwing money away. You're building equity is a statement. But for the first decade or more, majority of your payment is actually interest, not ownership on an amortization scale. A $400,000 mortgage at 7%, about $2,660 per month. And in this 1 year alone, roughly $2,300 of that is interest. Going to interest, less than $400 goes to paying down the principal. And then you tack on 1 to 3% in property taxes of value per year. And on top of that, insurance, $150 to $200 a month. On top of that, 1 to 2% of value every year, $4,000 to $8,000 on a $400,000 home goes to maintenance. Woo! The $2,600 mortgage payment quickly becomes $3,200 to $3,400 a month just to stay afloat. Yes, you're building equity, but you're also feeding a hungry monster that eats cash monthly. And when you sell, guess what you still have to pay? Real estate commissions, repairs for any inspections that fail, and taxes. Yes, they eat you up again if it's more than the $500,000 of capital gain if you're a married couple. Line number 3, renting is throwing money away. Cool, that's the guilt trip you've all heard. But renting isn't throwing money away. You see, renting is buying time, it's building liquidity, and expanding your financial flexibility. You're paying for control over your cash, over your location of where you live, and your freedom to pivot if need be. Now, in today's market, renting is often cheaper in most cities. Now, the average rent across America is $1,950. An average new mortgage, $2,700 to $3,000 before taxes and insurance. That's a $750 to $1,000 difference you can redirect towards a business, towards staff, or to your investments. Now, if you deploy that wisely, that is a weapon. So if you invest $1,000 at 10% for 10 years, that's $200,000. Use that same $1,000 to build a business, it could be worth millions. That's what I did. You see, renting without a plan, now that's losing. Renting with a strategy, now that's leverage. And here's a proof straight from the field. Now, lately I've been on this national Keep the Keys book tour, and I sat down with a real estate investor who's got over 81 doors and over $40 million in property. You think he was set for life, right? But you know what he told me over coffee? He feels trapped, house rich, cash flow poor, and after 25 years in the game, he has very little financial liquidity. He said, Matt, if a deal or emergency hits tomorrow, I can't move fast. If I need to rub together $500,000, I don't have it. That's the trap. And when your money is stuck in the walls instead of working for you, you lose agility. You see, liquidity is the financial oxygen for entrepreneurs. And most homeowners, they're suffocating without even realizing it. So as I wrap stuff up, consider this. Your investment is really a long-term debt pledge. Your equity takes decades to really matter. Your rent isn't waste. It's a wealth-building window, and even seasoned real estate investors can be house rich and cash poor. And when you stop worshiping home ownership as a symbol and a status and start treating it as a strategic choice, then you win. And that's exactly what I did. I stopped chasing the illusion of wealth through a mortgage till death and started chasing cash flow through creation. Now, here's how I turned rent money into a 7-figure business. When I had enough money saved down for a down payment, I didn't give it to the bank. Who did I give it to? Myself, in my own business. I poured that money into my own agency in the life insurance industry, of course, where I was an agent for the last 12 years. Why? Because being a self-employed guy, it was getting old. I burnt out. Because building an agency is a business model that I found later on and discovered was recession-proof, inflation-proof, and pandemic-proof. While the housing market was crashing and rates were climbing, my insurance agency was growing, expanding, and helping families protect income and and they're paying me for every policy we placed. For the first 3 years, we stayed disciplined and we rented below our means. We got another rental property and we found a better school for my kids to go to. In other words, we saved aggressively. We built leaders when we scaled our business. And by the time my peers had maybe $80,000 in equity to show for, guess what happened to me? I built a company worth multiple 7 figures. I didn't just build a house, I built an empire, a business. And once I had the income and freedom, that's when I bought the home that matched the lifestyle my business created. And side note, let me show you a picture here of my couple homes that we owned in the past. One was my bachelor home that I was renting and I eventually owned. And the other one is a home that I rented with my wife because she wanted to get out of the single dad home, okay, into our new home that we're going to rent together. And she was so happy about it. We were able to put our kids in a better school system. We were rented there for years. And my peers and my staff would drop us off at a house, excited to drop us off at a house and see, oh, this is where the millionaire lives. Just to be let down. They're like, so where do you live? Here? Yeah, humble. We tucked our cash away. We built up our credit score. We solidified our business. Now, here's some objections and truths I need to go through because I can already hear the critics typing in the comment section. But Matt, what about the tax benefits of owning a home? So let's talk facts. Since the 2017 Tax Cuts on Jobs Act by Trump, the standard deduction is about $13,850 for a single person and $27,700 if you're married. Unless your mortgage is around $750,000 or more, then mortgage interest isn't even factored into your standard deduction on your Schedule A. So for the average homeowner, there's really no big tax break of home ownership, just a bigger payment. But Matt, renting is like throwing money away. Really? Because in 2025, the average rent in America is about $1,950 a month, while the average new buyer, that mortgage payment, runs between $2,700 to $3,000 before taxes and insurance. And right now, renting is literally cheaper. That's hundreds of dollars in monthly liquid cash that you can use as capital, you can redeploy to grow your business and to build your wealth. But if you don't invest that difference wisely, then you lose. And here's my caution. Big players like BlackRock and Invitation Homes are buying up entire neighborhoods. And what's happening is they're fixing rental rates and they're cornering the residential housing market. If you don't get your money situation fixed right now, you could be locked out of an ownership of your home forever. So yes, rent with purpose and don't be passive. So let's talk real tax strategy though. Homeowners can use the Augusta Rule, IRS Section Code 208A, Chapter G. They can use this to rent their home to their business up to 14 days a year tax-free. And side note, my tax preparation guy didn't even know this. We had to educate him and later on we found someone else. And renters, you're not excluded. There are some benefits of renting. For example, if you legitimately run your business from your home, even though you're renting it, you can claim a home office deduction, a portion of rent, a portion of utilities, internet, and workspace. And that's what I did early on for my 2-bedroom apartment. I didn't own the property, but I thought like an owner because tax advantages aren't just reserved for homeowners. They're reserved for business thinkers. And listen, I wasn't born into that mindset. As a sergeant in the United States Marine Corps, I made about $20,000 a year my 8th year in the Marines. So there's no way I could save for a down payment living in Southern California, Orange County, Marine Corps Air Station, El Toro, and Tustin. And when I left the military, I became a single dad. I filed bankruptcy and I started earning multiple 6 figures, oddly enough, in the insurance business. Now, here's what I found. Kids were expensive and life became extremely real. This is when I realized I had to evolve from a self-employed life insurance agent to evolving into a business owner. And that mental shift changed everything. Because when I stopped working for money and started building a system that worked without me, my entire financial life transformed. And here's the truth. The American dream isn't about a white picket fence. It's about freedom. It's about control. Home ownership feels safe, right? But wealth isn't built from safety. It's built from strategy, offense and defense. So if you're in your 20s, your 30s, your 40s, stop rushing to buy a house just because everyone else is doing it. Rent with a plan. Rent with comfort and flexibility. Invest in your skills, grow your business, expand your cash flow. And you buy your home when your assets can pay for that mortgage, not only your paycheck. So if this episode challenged your thinking, good. Drop the word money smart in the comment section below, and I'll send you a free training showing exactly how I built my national life insurance agency step by step so you can learn how to think like an owner, not like an employee. If you're ready to go deeper, join the Money Smart Movement team where we teach you how to earn it, elevate it, and protect it. Because when you start transforming the way you think, you start transforming your money. That being said, please drop your biggest takeaways in the comment section below. If you haven't done so yet, make sure you subscribe to this YouTube channel, The 7 Figure Squad. Till we meet again, continue to live smart, continue to love smart, and be money smart today.